gave up managing billions to become a better investor. Episode 21, Earnings Season Week 1 Review. Hello, yes, it's the corporate earnings season over July and August 2023. What's been going on? What's been happening? Well, my last podcast talked about WD-40, which I regard as the start of the global corporate earnings season. By all means, listen to that podcast for my thoughts there. Saying that, it's kind of interesting, isn't it? I think WD-40 is a fantastic company, but a bit expensive. Saying that, the shares were up over 15% over the last week. Most of that since they released their numbers. So clearly there are some believers out there. My own personal view is high quality company, share price a little bit too firm for me at the moment. But there you go. Fascinating to listen to. And the last podcast talk about some of my insights from that. And certainly very helpful for general investors as to what's happening in the global backdrop and related. Saying that, from a global perspective, it's been kind of an interesting last week generally. We'll come on to some of the corporate return numbers over Thursday and Friday this week that's just passed in a few moments. But if you look at general markets, it's been a positive week pretty much for every area of the equity, the bond, the commodity and related markets, which is good. Obviously, it makes you kind of concerned about what's going to happen next. But from a pure perspective of is something performing or not, it's a tick in the box over the last week, last month, and frankly, over most areas year to date. Obviously, as we've talked about in previous podcasts before, this is largely equity centered, particularly in certain parts of the equity markets, technology being the big leader year to date. But for us sort of more, if you like, active thinkers, it's certainly an interesting profile for not just the corporate earnings season, but for the rest of 2023. Is it a boring world out there? Is it a world where you should be having most of your money in cash under the bed or something like that? Absolutely not, in my opinion. But there you go. Talked about this before, and no doubt we'll talk about it again over the upcoming rest of 2023. Let's talk about the corporate earnings season. As we've discussed over the last couple of podcasts, a super important time for any thinkers about all types of investments, not just equities, as we talked about last time, still very relevant for even bond investors, commodity investors, alternative type investors too. What's been happening in the corporate earnings season over the last couple of days? Because we started to have a few more numbers come out. On Thursday, I observed that there are a couple of what I would define as industrial stroke building companies, and also a couple of consumer good names as well. So two interesting sectors to talk about. And if we think about Thursday, I guess the place where, certainly from my perspective, obviously based in the UK, therefore, spending a little bit of my time looking at the UK market and relevant related matters, Barratt Development was the first stop. You know, interesting, well-known kind of building, home building name. They came up with an update, which I thought was a little bit insightful, although it's only just the start of a 10 there, because of course their main set of numbers will come out in early September. But nevertheless, I kind of got the impression that they still felt that there was some element of not necessarily pricing power, but a sort of a reason to remain relevant. Certainly lower costs, but also obviously lower demand as well. No surprise there, given recent moves in house prices and related, not just in the UK after all. So for me, the share is, I know a lot of people are big supporters of the building and house building sector. For me personally, I still retain the view that the critical thing for homes are to live in one. You shouldn't really regard them as an investment per se, although I know loads of people have, significant either building sector investments, or alternatively, they own more than one house. Good luck to them, I say, on that front. My view is, though, that the Barratt development numbers were just okay, and kind of in terms of indicative of lower prices, less inflation and related, definitely a tick in the box for that. But also in their case, it's a difficult market. Housing market is tricky, and consequently, even though I think the shares are probably a little bit cheap, am I chasing them here? Absolutely not. Am I interested in what the company is going to say in early September? Absolutely. Because as always with trading updates from names, you only ever really get half the numbers, probably not even that, to be honest. You get some interesting revenue and general broader theoretical moves. And certainly they haven't changed their forward forecasts. But nevertheless, is it enough to buy the stock, get excited about it? Absolutely not. I'll leave that one to the experts and happily come back to them in September for another deeper look. The other name, much more interesting in what I could define as the industrial stroke building sector, is Fastenal. And Fastenal is a US company. I think one of the most interesting is a bit like WD-40 in the sense that the sort of name which perhaps people don't know that well, but perhaps possibly have either utilized them or seen some of their products or maybe had other companies who's used their products, etc. And I really enjoy always the passion of the management of Fastenal, because for me, that's the sort of backdrop I love to see, where a company that was set up, a couple of generations ago, you've still got people working there who have been there for 20 plus years. And there's a lot of passion and thought there. A company which has had fabulous growth over the last 20, 30 years. Anybody who was smart enough to be an investor back then, huge tick in the box. I'm sure you're extremely excited. And frankly, probably nothing's done that well for you as an investment. For myself, I've been looking at Fastenal shares for maybe the last 5 or 6 years. And again, it's a great company at many levels, not just because of the passion of the management in terms of discussing matters and how trying to become more relevant and up to date with today's world, in terms of supplying other industrial companies and broader range of companies, etc. But also the fact that they talk, I think, in a very kind of straight fashion, in the sense that if something's going wrong, they'll talk about it. But if something needs to be changed, if they need to adhere to a new way of thinking, they talked at length actually about new e-commerce angles. Obviously, e-commerce is not new, but most companies are understanding that it's becoming ever more relevant. And certainly for a company supplying other companies, other industrial names, that's super important. And again, you kind of felt something very similar at WD-40 was being discussed. So did I like the passion and the insight of the Fastenal numbers? Absolutely huge tick in the box again. However, a bit like WD-40 actually, do I actually regard the shares as cheap today? Is it enough for me to induce me to buy the shares? Actually not. They observed a couple of small challenges that they're looking through in terms of changes that are being made by sort of a tweaked around management team and related. Does it sound to me though as if they've still got actually a business which is strong, taking market share, doing all the right things? Absolutely. Are they overly worried about more cautious general growth levels? I would say not. But are they recognizing their business has to change and evolve over time? Absolutely. And I think that's a good thing. For me, when I run the numbers and think about it more closely, bringing together the sort of the top down and the bottom up insights, important numbers, interesting insights from the conference call and related, $50 American dollars is about still my level where I'm going to become more interested in buying the share. So it's still one to keep on watching, but not to buy the shares at the moment, in my opinion, at least. In terms of the couple of other names on Thursday that I thought were interesting on the consumer goods side, two again US listed companies, although frankly, certainly one of them is a very international name you've heard of before, PepsiCo, because extremely well known, much more than just the soft drink, obviously lots of food and related snack and related items as well. A great company, a company I've had investments in the past, and unsurprisingly, a company that has done very well. Again, I was, impressed by the update they gave on Thursday. Not only the sort of the numbers they provided for Q1 / half one period, but actually the sort of thoughts towards where they perceived half two was going in terms of their pricing power and related. Still remains very relevant. As I say, much more than just soft drinks. And I think that's important because clearly having a slightly broader range of products, particularly as an international name, it's kind of an important thing. Again, a bit like Fastenal, company I highly respect, always enjoy getting the insights from. Was it a company, though, that I regarded today as cheap? And I didn't actually. And it's one which I'm still watching, still getting good insights from in terms of an understanding that companies with strong products still do have pricing power, which is a big tick in the box. Again, telling you that active investors will find, if they pick and choose carefully, interesting companies out there. Was it enough to induce me, though, to buy the shares today? Still isn't. It's still just a watch for me, not cheap enough to get involved. By contrast, Conagra, which is a little bit different, a bit more on the sort of the food products, selling products for sale ultimately in supermarkets and related, across many ranges. Although I think actually some of their frozen goods have been particularly successful over recent times. That was again an interesting update from them, and actually a share I do generally think is still, when I see a share price below $35 at the moment with the share, I still regard them as cheap. And, it's a good insight, good again. They've had a few challenges over the last couple of quarters, not so much actually a lack of consumer demand. That actually is not their biggest concern. They still have what is seeming to be a relevant underlying base. Are they being beaten up by supermarkets looking for better deals? I don't think so, actually. And I got the impression again that this is in that sort of box of quality name with pricing power and relevance. I think the frozen side is important for them because, as you may have read across the sort of the broader food and supermarket area, this has become an area that has become a little bit more relevant as perhaps customers get a bit more price sensitive. People thinking, okay, rather than perhaps buying stuff which is already made, or perhaps going to restaurants or whatever, let's get something, use the microwave and cook it that way. And it's become a little bit more popular. And I think Conagra has actually benefited a little bit from that. So actually, I think for me, below $35 where it is at the moment, I actually think it's interesting. I think that's actually a company which I would regard as cheap, and one where I observe solid free cash flow. Progress hopes for the next year seem okay, workable, doable. Is the company expensive? I'd say probably not. Are there some challenges out there? Of course. They talked at length about them in the conference call, which was interesting. And again, a company which, works hard to actually give some useful information to people. And overall, would I regard it as, certainly of the names that I've seen so far in the earnings season, the one that I'm most interested by still, I think that they would be. So they would be my certainly winner of this week in terms of the most interesting stock I've come across. Let's talk about Friday, though. Yesterday, as I speak, 5 names in terms of numbers and updates that I was looking at, a couple in Europe and 3 in America. The 3 in America are all in the financial sector. So if you hang on a few minutes, you'll get to hear about JP Morgan et al. Then. But the couple in Europe, one actually in the telecoms and related sector, Ericsson, Swedish name, obviously well known to many people. Obviously, any of those who remember the dot-com boom and bust, a very, very well name. And I remember back in my institutional investing days, my goodness, Ericsson was a huge winner. I think I'm correct in saying at one point, circa 50% of the Swedish market. And obviously, at certain early years of this century, things became much more difficult. Obviously, the company's moved on away from sort of a mobile phone centered approach, now much more, almost exclusively focused on the underlying supply of sort of 5G and related capabilities, which obviously is important because there's only so many companies providing that sort of underlying technical capability for from a telecoms mobile related perspective. Obviously, the Nokia firm being one of the other ones, again, a company that's moved away from mobile phones per se, focusing much more on, as it was initially, 3G, 4G, 5G, now potential for 6G and related. But clearly, there's competition out there. And as Ericsson talked about, the reality is that they regarded the world as choppy. And I can understand all the reasons why. Telecoms is a funny and quite competitive area. Whilst new rollout is occurring, more people are embracing 5G, and over time it will be 6G as well. The rollout for sort of the underlying capability from companies like Ericsson, it's not as easy as you think, and not as quick and rapid as perhaps people maybe would have thought, because it takes costs for the telecoms companies, and they themselves are saying, well, maybe people are rolling out a little bit more slowly in terms of buying new phones and hence having new capability. Clearly, the change is coming. but not perhaps as quickly as people are thinking, which is why it was kind of interesting to see on the Ericsson numbers, the growth during the quarter year-to-date periods has actually been in places such as India, where clearly you've got a quite interesting shift from 3G to 4G and ultimately to 5G and related. It's something which I've noted also in Africa as well, a little bit for Ericsson, but for some other companies too. So Ericsson, intellectually interesting, always a company which is trying very hard in terms of providing lots of useful data and insights. Always loved their presentations, not actually just at the quarterly basis. They give loads of presentations during an ordinary quarter as well for investors. Is it though a company which I'm regarded as cheap, a must-have? No, I'm not. And particularly when they sort of start talking about sort of some still caution towards 2024. So on my forward numbers, do I regard it as a company which is kind of cheapish for a reason? I'd say it probably does. At 50 Swedish francs or kronas or so, would I regard it as a more interesting value level? Probably. So again, look for a below 50 SEK in my opinion. Moving on, Burberry in the UK or UK listed, obviously again a global company, completely different space. I guess technically you call it a consumer goods company. Obviously some would regard it as luxury goods. You can debate that. Company I've been an investor in at various points over the last decade or so, actually more than that, quite a few times. I don't own it at the moment. I regard the share price as being a touch too expensive to get involved today. I think if you held it already, that would be fine. If you're a fan of their luxury goods, or however you want to describe it, products, then that's fantastic as well. Great products, no doubt about that. And I would still say, when I look at the company, and there's a newish CEO in there who I think, and a newish designer as well, who I think are probably on the lines of producing something quite interesting, certainly something which is very relevant for the second half of the 2020s. I like the fact that the company is progressively becoming more developing market centre. I think that's inevitable. That's the split of the world where growth is becoming bigger. And of course, it's not just based on growth per se, it's based on wealth. And that's very noteworthy when you see the importance of, let's say, Asia, the growing importance of the Middle East in something like Burberry's sales. Yes, there are still significant sales in Europe, UK obviously, for historic reasons, and the States too. I did note the States sales are slightly down year on year, which is in contrast to elsewhere in the world. And again, it's an indication that maybe some of those tougher comps in the States are becoming apparent, certainly for the luxury space, in my opinion. I'd say, though, new products, kind of relevance, good balance sheet, buying back shares, sensible free cash flow. It's all fine stuff. As I say, if you own it already, fine. Keep on holding. In terms of buy levels, for me, it's below £20, 2,000 pence a share, I'd say. That's the sort of level that I'm looking for personally, but just my opinion. But great company, and as clearly has been around for a long time, and no doubt will continue to be so. Moving on to financials, 3 US financials out, huge interest for all financial market watchers for many reasons, relevance for indices, well-known names, and I guess a few of the analysts work for them as well. Let's start off with JP Morgan, always the one which many people perceive as the start of earnings season. I think erroneously in my opinion, but there you go. You know my views on WD-40 and Fastenal and companies like that already. JPM numbers were all right. Shares responded well. They said sort of the right kind of tone of their comments in terms of the First Republic update. Obviously, that's going okay. I think they've got ultimately a good deal there. Clearly, volatility in the US banking sector and related has surprised a few people earlier this year. So I think obviously matters have calmed down a lot, and I think probably JP Morgan got themselves a good deal there. I'd look elsewhere though in terms of, and it's interesting, financial companies, banking stocks. I'm always intrigued, and I've probably said this before, how people value the companies. The sectors we've talked about so far today, kind of covering industrial or consumer goods and related, even telecoms, it's a much more kind of conventional way of thinking about stocks. For me, I come down to sort of boring matters such as EBIT, such as free cash flow. Yes, obviously some relevance for revenues too, but thinking about, what your EV/EBIT ratio is, what your free cash flow yield is, trying to work that in then from a bottom-up perspective as to what the company is saying themselves about the future, about their prospects. Very conventional and very relevant for almost all sectors out there, apart from, of course, financials, be it banks, insurance companies or related. So when you look at like a JP Morgan and the other names I'll talk about in a few moments' time, you look at it differently. And as always, when you start running some of the return on tangible equity numbers, when you start thinking about the appropriate multiple to base value a bank should be at, or a diversified banking offering stock should be at, it strikes me that a couple of things really. One is that people think about banks, I think, sometimes a little bit naively, because as always, you've got to think looking forward, particularly when we're at this moment in time where the scope for some tricky times for banks, be it bad issues with consumers, issues with other people they're lending money to. I guess for a company like JP Morgan with investment banking angles as well, some issues re markets, less demand, less angles being apparent there. So you sort of have to factor some of those factors in, and it's kind of interesting. JP Morgan also took a little bit of time talking about things such as issues with Basel III, which I know is a bit of a specialist subject and something which any financial sector watcher will be very well aware of, and kind of everybody else will be thinking, my goodness, what on earth are we talking about now in terms of complexity of financial thinking and related. And I agree, it is complex. Even I have to look carefully at it and try and work it through. But I guess what I'm trying to think, and it's sort of, we picked up elements of it early this year, really, with the volatility in the US financial sector. The reality is that in a complex sector where you can have strange macro and micro matters going on, or issues with valuation appropriateness of certain issues, it's a tricky space. And this is why I always put banking and insurance companies at a discount to perhaps what the kind of the naive or static look at kind of some kind of return on a tangible equity multiple of underlying book value would seem correct. And the reason for that is because I think I still see changes going on. It's funny, it's inspired, I may have said this before, it's inspired by a lot of my insights that I picked up from looking at Japanese financials during the 1990s, after their kind of period of great excitement and performance, a slowing, cautious Japanese economy, which has frankly continued for much of the last 25 plus years, how that has impacted how the average financial sector company in Japan has been perceived. When you have less growth in an aging population, guess what? You've actually got to discount your valuation a little bit. And so when I do that, I come up with $125 odd as an interesting level for JPM. Therefore, at sort of circa $150 odd today. Am I excited by the company? No. Is the sort of micro kind of broader insights terrible from JPM? Absolutely not. They're still talking about, a stable consumer environment. Obviously, they're starting to downplay a little bit some of the net interest income angles from higher interest rates, because my guess is they're getting their head around the fact that maybe interest rates aren't set to rise that much further in the States, and certainly when you start thinking about 2024 and beyond. As you know, my personal view is that central banks of the world should stop raising interest rates, but we shall see how we go. So I think JPM, it was useful. It was useful at many levels. Certainly, I think the Basel III, multiple comments was fascinating. They themselves are aware of the fact that perhaps some of the broader relevant kind of valuation appraisal by some of the specialist analysts out there will start to change and evolve a bit. Something I've seen actually quite a lot here in the UK over the last year or two. And again, when we talk about the UK banks in a week or two's time, I'll come back and talk about how, many people have been thinking erroneously about the banking sector because they've just been saying, wow, it's cheap. but they're forgetting that the world is changing. UK banks per se, but also about the appropriate valuation for financial companies. Anyway, so JPM, keep watching, always interesting, but I wouldn't be chasing the shares or buying them in any case. The same would kind of apply for Wells Fargo, which I'm trying to remember the last time I did hold the shares. My goodness, I think maybe it was during my time as an institutional investor. I certainly haven't held them as a personal investor over the last decade. It is much loved by many famous investors, Warren Buffett et al. Must be a little bit disappointed with the share over the last 5+ years. Company with great history, great multi-decade performance, of course. But I noted again, they talked at length about the net interest income angle, inevitably. Yes, I observed that credit quality they perceived as strong. They made some comments about sort of debt stress issues, which I think they themselves know are going to be relevant for future correct financing of financial sector names. Is it a name that, again, I would regard as cheap? You must own? Absolutely not. Do I find it interesting? I do. It's obviously a well-known company, a big company. A company that's had a few problems in a few years back and has kind of come back a little bit from that. But my observation is it's still not a name that I would need to chase or personally own. By contrast, the name actually, if I had to, if somebody said to me, well, which of the sort of the listed US financials are you most interested in at the moment, which I find the most interesting, probably would be Citigroup, actually. They also came up with the numbers yesterday on Friday. And for me, I'm still coming up with the notion that when I see a Citigroup share price below $50, I'm interested from my kind of valuation perspective. Now, Citi has always been a slightly different beast. And I remember back in institutional days, this was obviously, I'm thinking now in the sort of the years after the various global financial crisis issues. You may remember those back of the 2007 to 9 period. I remember visiting the States a year or two after that and going to see Citigroup because I thought, hang on, I can see some potential here. I like the fact that the company is not just US centered. Yes, they've got that investment banking angle, which obviously you've got to be a little bit cautious about variability and scope there. But I could see the fact that they were actually a bit more internationally oriented than some of the other US names. Anyway, I ended up actually buying the shares, and after a suitable appraisal, actually, I remember one institutional colleague, as it happens, an American, criticizing me, or at least saying, well, I'm not really sure about this. And to me, they were actually reacting to the fact their brain profile was very much centered on the 2007 to 9 period being relatively proximate, when actually the opportunity, of course, when everyone is fearful, that there's greed potential. That's what inspired me to go and see Citi. As always, important to do some real research and related, and ultimately ended up me buying the stock and actually making all right money out of them. I didn't own the stock forever, but it worked out for me. So I followed the company over the last decade or so since, and I find it interesting. And there's certainly a couple of things I've observed there. One, they are actually simplifying the business. And in a way, ironically, some of the reasons why I bought the stock sort of, what would it be, 12, 13 years ago or something, I guess, perhaps even more. Some of the reasons I bought the stock, that kind of international focus, which I felt was misunderstood, is actually now being simplified and moved away from areas being sold, Citi moving away from them, etc. And ironically, it will make them simpler, but if you like, a bit more kind of what I would regard as US bank stroke investment bank centered, which is kind of interesting. I'm not sure if that's ultimately the most excitable place to be focused in, but hey, from the perspective that there's always competition around the world, maybe that kind of works for them, given their good market share, obviously in US plus sort of areas. So I get that at a certain level. What I would observe is that maybe the fair value of Citi people may become a little bit more comfortable with the company. Hence why I think whenever I see the share price below $50, I'm actually quite interested. So if you like, Conagra was my most interesting share during this first week of earnings season. I guess the number 2 position probably would be Citigroup, actually, if I was looking for another alternative type of name. Do I own the stock? I actually personally don't yet. There's only so many stocks you can own. Do I actually feel that the stock is a little bit cheap? I think actually it is. Again, they mentioned correctly Basel III and related matters, upcoming issues. But am I still kind of ticking the box on the name? Yes. If you own the stock, thumbs up, good choice. I think you'll do all right in it, albeit a little bit of financial sector. Natural vol is always potentially out there. But there you go. There's some thoughts on my first week of the corporate earnings season around the world. Suffice to say, there's a bunch more stocks, even more stocks coming out next week. I'll come out with a new podcast, probably on Wednesday afternoon after we've had sort of the first 2-3 days of the corporate earnings season, with some further updates. I think there's a bunch of Swedish industrial names out, which is always very interesting for the global economy. A couple of other names too. ASML, for example, in the technology sector, again, from a European perspective, very insightful, among others. So I'll come back on those on Wednesday, and then further names, loads of names coming out on Thursday and a few on Friday as well. So a further podcast on a sort of next Saturday or so, sort of talking about earnings season week 2 and how everything's going there. But hopefully that was interesting. Again, any questions or thoughts about this, please feel free to email me or send me something on Twitter or something, and we can go from there. But thanks very much for listening, and goodbye.